But first, let's break down today's action with our market panel. Adam Crisafulli of Vital Knowledge and Charlie Bobrinskoy of Ariel Investments. It's good to have you both. Adam, I'm going to kick things off with you because we did have a relief rally here in the major averages, but not a whole lot has necessarily shifted for the narrative. So what gives?
Yeah, so I think you kind of have this tug of war that the market's been in now for the last couple of weeks, whereby you have these four very powerful tailwinds, the most important of which is stimulus. So that includes central bank cuts around the world, pretty much everywhere except for Japan, alongside what China just did in the last 2 weeks. So you have stimulus, you have relatively resilient growth. We've had some pretty healthy economic data in the U.S., disinflation, and then reasonably healthy corporate performance on the earnings front. And those four tailwinds are running up against very rich valuations. And so you kind of have this battle. The result is the S&P moving somewhat sideways. It's been kind of caught in this very tight range now. But that's really what we've been doing. And it's a tug of war day to day. On certain days, the elevated valuations leave the market more exposed. Some of these exogenous risks that we've been seeing, either geopolitical or in the political front in the U.S. But it's really hard for the market to sustain a sharp sell-off with those four tailwinds still in place. And I think this is going to be the pattern going forward. The bias will remain to the upside, but it won't be easy because valuations are extended.
Charlie, I want to get your thought on that, especially as we do see a U.S. economy that is holding up. You have a Fed that's beginning to cut here, but as Adam just mentioned, you have valuations that are rich, you have positioning that is stretched, and you have a lot hinging now, it would seem, on Q3 earnings.
Yeah, those valuation metrics tend to be good predictors of long-term performance, not such good predictors of short-term. The market can seem to stay at lofty levels for a long time, but in the long run, the best predictor of long-run returns are current price-earnings multiples, and those are absolutely extended for large cap. And we just have to recommend and remind that you can't just say the stock market. We have value stocks trading at much more reasonable levels, very close to their historic averages. The gap between PE multiples of growth versus value are at historic wides. So we would say, yes, the large cap tech sector is stretched and probably in the long term not going to produce great returns. Small and mid cap value is still reasonably priced.
Adam, what should investors do with China here? There's some disappointment that the stimulus, at least chatter about it, doesn't seem to be going as far as some hoped, and we saw a big sell-off in some Chinese markets over the last, several hours. Was the excitement overdone, or is this just a bit of a speed bump on the way to continued upside?
I think it's more the latter. The velocity of the move that you saw in China was unsustainable. In any market, you had just this enormous rally that occurred over a very brief period of time. But if you really look at what they've done, they're pulling some very powerful levers on the fiscal front, on the monetary front, and then they're also changing a bunch of rules around the housing market, which is obviously an important critical component of the economy. And this is a real notable change from the government. You still do have this, the geopolitical angle where you have trade tensions rising between not just Washington and Beijing, but Brussels and Beijing and a lot of other countries as well. So the coast is far from clear, but I don't think what you saw was kind of a flash in the pan move. Again, in the immediate term, the rally did require a little bit of give back and some digestion, and we saw that. But the policy changes are very powerful. So I suspect you're going to see further upside from China-linked equities.
Okay, now, Charlie, revisit for me, if you will, your strongest value narrative right now. There's a lot of uncertainty. There's this volatility. We've got an election coming up in just a few weeks. But there should be some things beyond that and into 25 that investors can sort of hang their hats on if they're kind of scheduling what they're going to buy and at what prices. Where are you seeing opportunities that are more than a few weeks long, but that are quarters long?
Yeah, I would argue that the relative inexpensive nature of value stocks is because people were very worried about a Fed-induced recession. People thought that the Fed was fixated on bringing inflation down by reducing the pace of the economy and reducing the job market. I think that is fundamentally been relieved. That concern is nowhere near as high or as justifiable as it was even 2 months ago. The economy is clearly has less likelihood of going into recession than it did even 2 months ago. And so the value stocks, which admittedly are more sensitive to the economy are in better shape, and that's not fully reflected in their stock prices. The value stocks had a very good July, but gave a lot of it back, frankly, in August, and so are trading at a much more reasonable level, assuming we don't have a recession, which I don't think we're going to have.